Hi everyone, it's Aleem here. In this video, we're walking through exercise 3.5 out of the Weygandt Introductory Accounting textbook. In this question, we're looking at adjusting entries, and this is probably one of the things that students struggle with the most in introductory accounting. So I thought it would be a good idea to walk through in quite a bit of detail how we do this question, because it gives you a lot of different examples of some of the kinds of adjusting entries that you could run into. We're going to take it step by step. After each one of the questions comes up on screen, I would recommend you pause the video, give it a try for yourself first before looking at the solution as I reveal it, and then once you've gone through it on your own time, then hit play again, watch for the solution, see if you got it right. All in all, I'm hoping that this is a pretty fun experience for you. So let's give this a try. Action Quest Games adjusts its accounts annually. Okay, so first of all, they're telling us that they're going to do this on a yearly basis. Assume that any prepaid expenses are initially recorded in asset accounts. Okay, so they're telling you a couple of really important things here. One, they adjust annually. Any prepaids are in asset accounts, and any revenues collected in advance, so if we get paid up front, they record those initially as liabilities. The following information is available for the year ended December 31st, 2021. And that's another really key piece of information. If we know that the year end is December 31st, 2021, all of our adjusting entries need to be made to that date. For each transaction, prepare the journal entry for the initial transaction. So what we're going to do is record the cash transaction, whether we're paying the cash or receiving the cash. And then for each transaction, prepare the adjusting or the adjusted journal entry. On December 31st, 2021, it's saying to do both entries before proceeding to the next one. And that's exactly what we're going to do. So step 1, record the initial transaction. Step 2, prepare the adjusting entry. You ready? Let's take a look at the first one. A $4,020 one-year insurance policy was purchased on April 1st, 2021. So there's two things that we need to watch there. Is it's a one-year policy, and we're buying it on April 1st of 2021. What that tells us is that this insurance policy will run from April 1st, 2021 to April 1st, 2022. And because this lasts for an entire year, our adjusting entry will need to happen on December 31st, and we'll talk about that in just a second. First of all, let's talk about the initial journal entry. We purchased a $4,020 policy, which means we paid for it. And what we're going to say if we've paid for it is debit prepaid insurance, $4,020. One asset is going up, and that's prepaid insurance. The reason it's an asset is because it provides us future benefit. Right? This insurance policy is lasting not just now, but into the future. And then cash goes down because we gave up cash. Remember, to reduce cash, we're going to credit cash. So we're debiting prepaid insurance, crediting cash. Our adjusting entry, and this is what's going to happen at the end of the year, we need to take that $4,020, multiply it by the number of months. So April, May, June, July, August, September, October, November, December. Right? That's 9 months out of the 12 months of this policy. 4,020 times 9 over 12 gives you $3,015. So now what we need to think about is on December 31st, how do we increase the expense? We're going to debit insurance expense and then reduce our prepaid insurance by crediting prepaid insurance. So what we're going to see is that we're reducing the $4,020 by $3,015, and that's again, what our goal was to do is to record the expense, and now for the year 2021, from April to December, we've got $3,015 in insurance expense. And our prepaid insurance, even though it started at $4,020, has now been reduced by $3,015. All right, let's check out the next one. Paid $6,500 on August 31st, 2021 for 5 months rent in advance. So what are the keywords in this sentence here? $6,500 was paid, so we gave up $6,500. When did we do that? We did it on August 31st, and what are we prepaying for? And that's for 5 months of rent in advance. All right, so let's walk through this here. Our initial transaction, prepaid rent is going to go up, cash is going to go down. Oh, let me back up for a second here. Prepaid rent is going to go up, cash is going to go down, debit prepaid rent, credit cash. Our journal explanation there is paid for rent in advance. So what's our adjusting entry at the end of the year? Now think this through. How many months have we used? That's right. We've used 4 of the 5 months. So $6,500 times 4 over 5 gives you $5,200. Debit rent expense, credit prepaid rent, $5,200. All right, let's try the next one. On September 27th, 2021, we received, so this is us getting cash. Cash is going to go up. We received $3,600 in cash from a corporation that sponsors games for the most improved students attending a nearby school. Now, it hasn't told us yet how to recognize that, so let's see what it says when we keep reading. The $3,600 was for 10 games worth $360 each that are played on the first Friday of each month starting in October. So what we're doing here is we're getting $3,600, and each time we put on a game, we're going to recognize $360 in revenue. But first we need to record the $3,600 that we received before we even talk about any adjusting entries. So let's do that. How do we increase cash? We debit cash on August 31st for $3,600. Credit unearned revenue. Was it August 31st? Let's go back and just take a look here. On September 27th. I've got that date wrong. It should say on September 27th, not August 31st. My apologies. We received $3,600. So this journal entry here should say September 27th. So go ahead and fix that. I'm already into this video, so I can't do that anymore. Debit cash, credit unearned revenue. And now what we're going to say is when would be the first game played? We have to think about the calendar here. Let's think about what that would look like. We've got October, November, and December. That's 3 months. That's out of the 10 games. So we're going to put on a game in October. We'll put on a game in November. We'll put on a game in December. $3,600 times 3 out of the 10 games gives you $1,080. What's our journal entry? On December 31st, debit unearned revenue to reduce unearned revenue and increase revenue, credit service revenue, for $1,080. Okay, and that's going to be to record the revenue for services performed. Our service in this case is to put on the games. That's exactly what we've done. All right, so the next one here is signed a contract for cleaning services starting December 1st, 2021. Now that in and of itself isn't the journal entry. It's not the transaction either. The transaction is, well, let's keep reading, for $500 per month. Here's the transaction. Paid. So there's the verb. We paid for the first 3 months on November 30th, 2021. So on November 30th, what we're going to show is we're going to increase prepaid expenses by $1,500. We're going to credit cash or reduce cash by $1,500. Now, this is for 3 months. How many months are we using up? Well, just December, right? This is on November 30th, so we don't count November. What we're going to talk about now is just December. So on December 31st, one of those months is now used up. 1,500 times 1 over 3. Remember, this is only for 3 months. 1 over 3, and that gives you $500. And our journal entry then is December 31st, debit office expense to increase the expense, decrease owner's equity. That's $500. And we're crediting prepaid expenses. Okay, let's try one more. On December 15th, 2021, we sold $935 of gift certificates to a local game club. On December 31st, 2021, it was determined that $545 of these gift certificates had not been redeemed. So now let's think about this information that we're being given here. We sold $935 of gift certificates, which means we received cash, and in exchange we gave up a gift certificate. Now, is that the service? Can we call that revenue? And the short answer is no. And it's not revenue yet because we haven't done what we actually promised to do, and that is to make good on the gift certificates. In the same way, if you walk into a coffee shop and you buy a gift card, the coffee shop can't call that revenue until they actually give you the coffee, right? The little piece of plastic doesn't do anything. So here we're going to increase cash and increase unearned revenue for $935. Then they're telling you that $545 of that amount had not yet been redeemed. So that's the amount that we still owe on December 31st. When we set up our T account, because that's how we're going to approach this problem, we're going to need to think about where does the $935 go and where does the $545 go so that we can figure out what we're going to record as our transaction. Our initial transaction is fairly straightforward. On November 30th, we are going to increase cash, debit cash for $9.35, credit unearned revenue for $9.35. We received cash in advance. Our year-end adjusting entry, what we're going to show here, have you got it? Where does the $9.35 go? Well, we debited cash, and if we look at the unearned revenue account, it's going to show up on the credit side. The $5.45 is what we still had, and that's going to go at the bottom. And then the $3.90 is the amount that we're missing. Right? So we take $9.35 minus $5.45, and that gives you the $390. That's the amount of revenue we've earned. So we're going to debit unearned revenue to bring it down and credit admission revenue for $390. And this is to record the revenue from services performed. Had this been service revenue, you could have credited service revenue. In their chart of accounts, this company happened to call it admission revenue, so we'll use that and call it admission revenue. All of these would be lumped under revenue on our income statement. Alright guys, that's it for this video. Thanks for watching. I hope you enjoyed it.